Are you failing in your job? Are you struggling to make your grades? How about just having a bad day? Well, all you need is some perspective. That's exactly why I'm here, to brighten up your day so we can all laugh at my pain. In this video, I'll be covering my 3 largest losses and exactly why it went so terrible. And when I mean terrible, I mean terrible. Now, if you guys are new to my channel, my name is Sam. Stocks is a game, money is a name, and that's exactly what my channel is about. If you enjoy this kind of content, make sure to drop a like, subscribe, because I give out free advice on all different stocks I'm looking into. In my last video, you can check up in the corner up here, I talk about my favorite stock for beginners, so give that one a watch once you've watched this video. Okay, let's jump right into the video with my first stock now, Boohoo stock. Right, to give you some context of what Boohoo does, they're a British online fashion retailer that's aimed between 16 and 30-year-olds, and the business was founded in 2006 and had sales of close to 900 million in 2019. It specializes in its own brand fashion with over 36,000 products, and it also offers lots of other various brands which they've acquired over the years, such as Boohoo Man, such as Debenhams, and such as Pretty Little Thing. So I originally bought Boohoo back in July of 2020 at £2 a share after the stock had pulled back from £4 all the way to £2 after a slight scandal around the supply chain. I thought this was a much more short-term factor rather than a long-term factor, which is why I jumped into the stock so quickly. Okay, to shed a little bit more light on the scandal, it was much more to do with Boohoo's suppliers rather than Boohoo themselves. Their suppliers were underpaying their staff rather than Boohoo actually underpaying their staff, which is exactly why I thought it was a much more short-term factor rather than a long-term fundamental change. And to my surprise, I was actually correct. It went from £2.20 back up to around the £3.75p mark. And I thought I was an absolute genius here, and I ended up making a little bit of money on this stock, selling out around 50% of my position. But this is where the real story starts now. As we know, back in 2021 and 2022, the stock market took a big nosedive with the big word inflation. With inflation, I then took the similar advice to the Fed pal, favorite word of all time. That word was transitory, and it was anything but. So after making a bit of money in Boohoo, I ended up selling out most of my position back in 2021 at around the £3.30 mark. After the market sell-off, I bought back in around at that £1.80 mark back in October 2021. I then averaged down all the way to the £1 mark, which was an absolute massive mistake, which I didn't quite realize at the time. Right, the 2 mistakes I made was purchasing power and inventory. 2 things I underestimated massively with a company like Boohoo, and I didn't think the impact of inflation would hurt Boohoo as much as it did, to be perfectly honest. So first is purchasing power. I originally thought that Boohoo had a good brand and a good brand name, so they'd be able to raise prices slightly to help with inflation and reduce that cost risk. As inflation increased costs as well, this meant that Boohoo would try and increase their prices, but this can't be the case as they're a fast fashion brand and they're a very low quality, so you can't increase prices for the same products that just are a load of rubbish. They want to get rid of them so quickly, and this led on to my second point, the inventory. They had far too much inventory, so what they had to do is they ended up having to liquidate a lot of this inventory at lower prices, which just meant that they weren't creating enough profits to keep with the demand. This then led to the stock plummeting and ended up at 37p a share as of Monday. Luckily, I managed to sell out at around the 85p mark, but then this led to a 4 to 5k loss in my portfolio, which was a very painful experience. On to my second stock now, TTCF. Yes, I was first made aware of this stock by a certain individual, but at first glance, I originally thought that the business had a lot of potential. So where did TTCF go wrong, and where did I get in? Well, I first got into this stock at around the $17 a share mark, and once again, I had a bit of luck riding this up to around the $25 mark. I actually fully sold out of this position at this point and locked in my profits because I thought the stock was overvalued at that particular point. However, after that point had passed, back in around 2022, I decided to jump back into the stock exactly when the stock started plummeting. I thought I was getting some real value where the brand had slowly improved. However, this certainly wasn't the case. Essentially, what was happening with TTCF is that they were acquiring new businesses that were white label service brands. The problem with white label service brands is they're very low in margin, and this doesn't help with their brand name and improve that organic growth, which is a real big concern for a small company that is very unprofitable. So you can see the mistake here already building. With that macroeconomic environment also declining, this puts extreme stress on an unprofitable company like TTCF. With low margins, bad organic growth, and a poor brand reputation, it was a recipe for disaster. Their acquisitions weren't working, and this was down to that white label service that wasn't going to improve that brand reputation. Now, ultimately, the biggest problem was cash position, which was dwindling over time. This meant that TTCF had two options. They could either raise capital through debt equity, or they could do it through share dilution. Now, share dilution works if your stock price is much higher. However, when your stock price has been devastated like TTCF, you have to issue more shares to raise the same amount of equity. And this was something that was going to hurt TTCF in the long term and not an option realistically. Now, the second option was through debt. However, when you have a macroeconomic environment where interest rates have risen from 0 to 6%, this only puts extreme greater pressure on that debt obligation, which is another reason why they couldn't raise his debt, because it would have just led to an absolute disaster for TTCF. This stock was a big lesson learned for me personally, as I didn't quite gauge the understanding between that organic growth and the brand reputation. We needed to see more organic growth in TTCF that would have helped this company increase that brand reputation, ultimately drive sales, and then drive profits greater. They'd have more purchasing power, which is a massive standpoint for an unprofitable company. Now, if we compare this to another stock I've recently looked at, Hims & Hers is the complete chalk and cheese of this company between TTCF and Hims & Hers. This is because they're driving this growth through organic growth, which is why this company, TTCF, has helped me to identify other opportunities in the market. So to be fully transparent, I'm actually very grateful for the loss I took in TTCF. I ended up selling out around the $15, $14 mark and ended up losing around £2,000 to £3,000. Even though I lost this type of money, it wasn't the end of the world, as it helped me identify other opportunities in the market, like Hims & Hers, for example. And going forward, I'll be able to use this information, understand how organic growth works, why it's so important to a brand and its brand reputation, and also how acquisitions can be implemented efficiently. All three factors are going to be so important for identifying a stronger business. Okay, my third stock now is Alibaba, also known as the Chinese Amazon. The price performance of Alibaba has been nothing short of absolutely insane. It's fallen from $300 a share back down at $95 a share, which ironically is what it IPO'd at back in 2014. Right, so I think the mistake here is quite blatantly obvious, and that's it's a Chinese company, and that comes with the political uncertainty, which the CCP is intertwined between the American investor and obviously the Chinese business itself. It's weighed in on the performance massively, even though Alibaba is actually a really good business. Well, you might be saying right about now, well, Sam, you're a long-term investor. Why not stick it out with a company like Alibaba? And I totally agree with you. I think long-term, this business probably can do well, but the biggest uncertainty is around that Chinese economy. Now, with the Russia and Ukraine crisis happening, this was the main reason I had to get out of this company. I originally bought this company at around the $150 mark, averaged my way down all the way to the $120 mark, and I thought that as soon as that Russia-Ukraine conflict started, I knew I needed to get out of this company because I understood that the political uncertainty was going to be weighing in on Alibaba's performance for a long time. And this is exactly what's happened. We've already seen this company go back down to around $70 a share. And it's, even though it's performed slightly better, back up to $95 a share. With so much good news coming out of this company, I can't believe it's not higher. Now, if you guys want to check out a full breakdown of Alibaba, me crunching the numbers, understanding the business, make sure to check it out up here because I break down a full in-depth review of Alibaba. So ultimately, I ended up having to sell out of this company at a loss at around the $112 mark. Even though I averaged down, I made my position significantly larger, which led to that £4,000 loss in my portfolio. Now, even though the stock is lower, I clearly made the right decision right now. But I think that maybe in the future, I may want to jump back into Baba when we see a bit of stability within that Chinese economy and also the political uncertainty surrounding it. I want to see more stabilization before I can fully jump back in to a company like Alibaba. So in summary of the three businesses I lost money in, the first one was Boohoo, and this was driven primarily through that macroeconomic changing environment. This meant that Boohoo had less purchasing power, too much inventory on their balance sheet, which meant they had to liquidate that at a loss. This then weighed in on their performance, particularly their revenue and also their profits. Their profits were down significantly, and I ended up selling out around a £4,000 to £5,000 loss. And this stock is currently at 37p, which just seems insane. But in summary of my second stock now, TTCF, I actually felt like it was more of a blessing in disguise. It helped me understand that acquisitions doesn't always benefit a company. That is driven through organic growth, which can build brand reputation. We want to see this in other companies, and it helps me identify other companies now, which I previously wasn't able to. I obviously led to around a £2,000 to £3,000 loss in TTCF. However, I was able to make this back very quickly with other stocks I was looking at the time, such as Overstock. Now, the final stock being Alibaba, this is one that hurts the most for me personally because I still believe in this business. I think it's got some great long-term potential, but the political uncertainty is weighing in on the performance, and it's currently trading like a nano cap. There's zero liquidity in this business right now, and it is weighing in on that performance. So in total, I took a £4,000 loss in Alibaba, a £4,000 loss in Boohoo, and a £2,000 to £3,000 loss in TTCF, which equated to around £11,000 total, which is a big amount for someone like me, which doesn't have the biggest portfolio in the world. But I've been able to build that back up with my new understanding of my mistakes. You always got to have these lesson learned, which is exactly what I've taken from these three stocks. Now, if you guys enjoyed this video, make sure to drop a like, subscribe if you haven't already, and I'll see you guys in the next one.